Welcome back to another episode of the XRP podcast. It's going to be a good one today. Of course, joining me is Mr. Versan and Vandel from BlackSwan Capital. You guys have seen him on the show before, but welcome back in, guys.
Good morning, Paul. It's a real
Yeah,
pleasure. Thank you for having us on again. It's always a pleasure to see you.
Well, our
thank
last
you.
video did so well, man. We had so many comments. People were just like, this is a conversation that should be like in a collegiate academic program, you know? And I was like, I was like, well, wait a minute. We actually are trying to make this easy for people to understand.
Yeah, we'll water it down this time. Keep it simple.
Try to.
Yeah. Let's get into some of the podcast talking points we're going to hit on today. Of course, we're going to go into the whole issue around liquidity. What's going to drive into that? Because liquidity is the lifeblood of crypto. We'll talk a little bit about the repo markets and why that's important to crypto. You guys will want to really kind of pay attention. Take some notes out there. And hopefully this will help whether it's your XRP bags or some of your other, crypto and risk assets. It all boils down to one thing, Versan, and that is how liquidity is going to be injected into the market. So let's talk about the repo markets first. So let's first explain what the repo markets are for our listeners and our viewers. When people hear that, a lot of times they don't really understand what the overnights mean. So give us a rundown.
Well, the repo market facilitates short-term collateralization through loans and through repurchase agreements, where basically one party is selling securities and agrees to repurchase them at a larger, higher price.
Yep.
And you could easily bring parallels from 2019 and the repo crisis. It's really a perfect example to show you how fragile traditional liquidity markets can be. And when banks suddenly need to have overnight cash and the Fed has to step in aggressively, and this is probably why the government shutdown took place so they can cook the books and now they're going to reopen them again. Essentially, they're creating liquidity out of thin air, meaning more money printing. The FOMC meeting recently confirmed all of this. And it also does show, again, how fragile liquidity markets are. So, when massive institutions are vulnerable to short-term liquidity crunches and traditional finance is not as smooth as predictable as people think it is, this is where kind of maybe you could tie this into XRP infrastructure fits in. Unlike traditional rails, it could provide instant settlement 24/7, doesn't require waiting for correspondent banks or settlement cycles. So when you have systemic stress in liquidity markets, XRP could potentially serve as a bridge that moves assets across borders instantly and providing that liquidity. So I'm trying to bridge the two in here. It's just, I think the whole crypto rails is going to become ultimately the solution that will operate continuously while markets are under stress. And you can even tie this into Jake Claver's reverse carry trade.
Mm-hmm.
Yeah.
Yeah, well, the reverse carry trade, just as a precursor for some of you, basically the Japanese buy a bunch of U.S. bonds and treasuries, and they prop it up. If they ever sell those, it puts a lot of pressure on the U.S. government. And the idea is that what we're trying to do, I think, when you look at the U.S., trying to basically circumvent that with stablecoins to be able to export those globally to kind of help support. If one major nation were to start selling securities, you got a backstop of other companies, which are really stablecoin companies, all buying into treasuries, which almost like they're taking the debt off of the global stage and now putting it into these stablecoin companies, which is, I don't know if this is going to be a good thing or not.
Yeah, basically. But like we said before we start recording, there are just so many moving pieces and trying to bridge it all and make it all make sense.
Yeah.
A little challenging,
You brushed on something, though, that was kind of a throwaway quote, and that is the government shutdown to allow them to cook the books. Okay, now explain that a little bit further. We gotta understand what that means.
Well, I think real quick, I'll let my brother go ahead and finish my thought there, but I think what they're doing is looking for any excuse to justify further actions and further intervention, essentially producing more stimulus. And that's kind of what drove the 2020 bull market even. So we're seeing a lot of the same parallels.
Yeah.
If they could cook the books, shut down the government, create all these political narratives and excuses to justify what they're doing behind the scenes. And now with Trump coming out saying, hey, we have a deal with China, we have, $2,000 potential stimulus checks. I mean, this is all, it's not politics. It's all about justifying further liquidity intervention.
Yeah.
Injections. That's all.
And I'd like to add to that. So every first Friday of the month, jobs data is supposed to come out. Now they couldn't do that. As a matter of fact, ADP said they couldn't release approximately 20% of the job data because the government is shut down. How convenient. So what's interesting here is that in conjunction with all the other macroeconomic factors playing out. So if you really zoom out and take a big picture look at it, it really reflects that something fishy is going on here because of timing in conjunction with all the other factors playing out. So just to illustrate my point, approximately 20% of the jobs data was not been able to be released.
Yeah.
And the interesting part here is that this is the perfect excuse to actually cover up how horrible the real state of the economy is.
So you think there's actually a concerted effort here to hide some of this data?
Yes, absolutely. Yeah,
Wow.
there's it's very obvious to anybody paying attention, but that is my belief. Yeah. Because the economy is doing horrible. It's primarily, GDP has primarily been driven
By top
by,
1%. Yeah.
yeah, that too as well, but even AI growth,
Mm-hmm.
you know, artificial intelligence, you know,
Yeah,
so it's
all the AI
artificial.
froth
Yeah,
that you see in the
yeah.
system. Yeah, if you look at the S&P
Exactly.
today after reverse, it's interesting that you get a whiff of a government opening, and the first thing that takes off is AI stocks.
Interesting.
Yeah.
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 Mhm.
So it's no surprise. And AI is a bubble within itself.
Yeah.
Personally, I
You were
think
gonna
the
add
big,
something there,
go ahead.
Vasant.
Well, I like to my brother's point, the policies are not just, they're improvised. Okay. These were all kind of set in motion months ago. And also you could justify the fact that rates are now lower and they may drop even further. And that's just a narrative. It only strengthens the setup that we're talking about here.
Yeah, I think, well, and let me add, just to show you guys what we're talking about. This is the NVIDIA chart right now.
Okay.
And we're looking on the 4-hour. So literally since the whiff of a government opening, this is what happens. You get this kind of reversal back up to what could be back up around $200 on NVIDIA, which would bring it back near its all-time high, which was 208. So the froth that you're talking about, everything's up. Look at Palantir, up 6% this morning, which is another AI play. And then if you just look at the S&P right there, there's the bump that we've been looking at after a downtrend in the market. This again on the 4-hour. But with all this playing into this, guys, and I want to go back to the point that you guys were getting at on the potential for the overnight, because this is a big deal. I remember when the repo rate spiked in 19, it went from like a 2% to a 10%. This was in just a few hours.
And the Fed intervened. They had to inject billions of dollars in reserves.
So my question is, are we at the cusp of that? Because we know that tightening is supposed to end on December 1st, right? The real question is when would quantitative easing, in other words, injecting capital into the system, would that occur? Do you think that's going to occur literally next step, or would this take a few months?
Yeah. So based on everything playing out and the rate at which things are moving, it seems the Fed is trying to contain the situation. So quantitative easing, they have all types of complex jargon and language to kind of beat around the bush. I mean, they've been doing QE for a while, but stealth QE. There's different forms of it. But quantitative easing, as we know it, that emergency liquidity injection when the Federal Reserve is forced to step in and expand their balance sheet to enormous amounts, I think that's inevitable. It's going to happen. The debt-based system, the architects of this system built it in a way where, first of all, the debt never gets repaid and governments constantly have to borrow. Now, what that means in essence is this debt-based system and the mechanism of fiat money, the money system, has massive implications. And one of them is that there will always be something breaking in the system. That's one of the implications that's built and baked into the cake.
Right.
And the reason is because when credit stops flowing for whatever reason, it could be something cracking in the system. which is primarily all financial crises are actually at its root a funding mechanism issue or debt refinance issue. But when the money stops flowing and credit stops flowing, financial markets cease. So basically, crashes and collapses in the system are baked into it. So it is inevitable. It's going to happen. It's going to happen because of excessive leverage, and something's going to break. So QE will be an emergency response naturally to artificially inflate the system and keep it afloat. So they will have to do that.
Yeah, in 19 it was 75 billion immediately, then hundreds of billions were like right after that. So you're talking close to $500 billion that we're starting to see injected in. And remember, the reason that a lot of this mattered was because of the bank issues that were happening, because they were hoarding cash, which meant that they were very less likely to lend, which slows down credit dramatically to small business, which of course gets to your point. This starts to hit on the economic front, which is why the Fed has to do this. It's the flywheel, you know.
Yeah, which is also why the Fed had to propose the law, the supplemental leverage ratio, which basically, in simple terms, it basically means, hey, banks, big banks, take a lot of leverage, you know, and take a lot of risk, and you just need to hold fewer reserves, save capital. Basically, that's what they're saying to the big banks. So why would they even propose that? You know?
This time around, though, do you think, Versan, that we're in a different state of average day people, everyday people that are looking at the risk markets, they're looking at gold now, they're looking at other assets that are really going to put some pressure here on the banking system, almost as if, and then you, of course, you have stable coins, which even Ken Griffey was talking about this, you know, Jamie Dimon talking about this. They're concerned that we could see a real run on the banks.
I wouldn't be surprised.
Yeah. So if that were to happen, what wins, you know, on the backside?
Honestly, I think gold does. And, you know, for stars, even from the discussion we had last time, what did I say? The first thing I said was, I think the real question on everyone's mind is, what is a store of value?
Yeah.
And that's why I always like to start with that. I constantly reiterate it. And I still encourage people to hold physical assets like gold and silver, because as long as we're living in this fiat based economy, individuals do need to protect and preserve their wealth with monetary hedges. That is indeed gold and silver. You start to look at the broader picture, it's actually increasingly clear, and this is very clear for people who truly understand the financial system, that gold and even silver are gradually being reintegrated into the monetary infrastructure. Saw gold since we last spoke hit over $4,400. And it's simple because banks can now monetize and re-leverage the system. And that's kind of tying us into what we're talking about here with the repo market. And ultimately, I think gold and commodities in general, a basket of commodities, is indeed becoming like the backbone for traditional finance and the emerging digital layer. And that's why I always try to bridge like XRP with gold and stable coins to some degree, because I think when digital assets do come into play like XRP, you have this system that is now being built to consolidate and absorb value across multiple asset classes. We're talking about fiat, commodities, bonds, and even more. So essentially, XRP, in a sense, functions as that settlement layer that overlays everything that's being put into motion. But in a digital paradigm, you still need an underlying asset as collateral, and I still believe it's gold. So I think gold really wins at the end of all of this, and I think XRP plays more of a settlement layer upon it.
Well, it's interesting because you look at the immediate reaction to the government shutdown possibly ending. If it goes to the Senate, I know we still have more to go, but at least there is a referendum that has started the motion as of this morning on Monday when we're recording this. Likelihood is when this podcast releases, hopefully we would have a decision and a date for the government to go live. But with just that on Monday morning, and you would think that with a government shutdown saying, "Oh no, we're ready to go," that gold would slow down, but instead it accelerated.
Yes.
Yeah.
It's similar because gold is at the Bank for International Settlements into the regulatory frameworks that you see being laid out. Gold is, again, becoming collateral. That much is clear.
Yeah, there's the 4-hour right there, guys. So what was over the weekend around 3,900, now back up to almost 4,100, which is a big move for gold. That's a big move.
Hmm.
These are the kind of things that start to spook me a little bit when you start to see, wait a minute, the government's opening up. Why is gold climbing the dollar? You would think it would be the opposite of that. Now you see AI stocks starting to run, Bitcoin starting to run, all risk assets starting to run again. Do you think people are a little bit more concerned? And look at XRP this morning. I mean, this is
Yeah.
XRP. Let me bring up the XRP chart. Obviously, some of this is ETF driven, but that's the XRP chart, guys, right there on the 4-hour after a
Mhm.
huge weekend, now cratering what was everybody thinking that it was going to be around $2. And we got our shot at it. Right there was our last real buy purchase zone, which was around 218.
It was a good opportunity. Yep.
That was it, man.
And Paul,
Yeah.
you bring up a very important
Look at
point, and
that.
if I may, yeah, that's incredible. I mean, Vindel and I have always said that XRP would eventually decouple from the broader crypto market, and I think we're starting to see a little bit of this trend. Here's a useful analogy: is gold how it decoupled from interest rates, and historically, gold's price usually correlated with interest rate movements. That means higher rates can reduce gold's appeal
Right.
because opportunity of cost of holding a non-yielding asset would increase, right? But now we're seeing the trend of gold no longer reflecting monetary policy anymore.
Mhm.
Basically, its purpose is, again, acknowledged in a different way as a store of value, more of an intrinsic value in its role in the broader financial landscape. And I think XRP gradually will undergo some similar shift where it will decouple from Bitcoin, where it
Interesting.
will decouple from the rest of the market because its recognition, like gold, is going to be independent from something that is speculative to these cycles. And to my brother's point, as long as they are going to keep expanding the debt, you can expect more liquidity to be entered into the system. But gold is decoupled from rates, and it's now being used as a store of value and as collateral again. So I think XRP also will eventually decouple from Bitcoin and Ethereum because its function is really settlement and liquidity efficiency. And
Yeah.
that's the real takeaway from this.
Well, and you look at dominance, which has been falling on Bitcoin. This is the Bitcoin dominance chart. I'll bring that up so everybody can see it. But
Mhm.
this is the kind of scenario that I think some people have been looking at whether or not this can hold. And do we see it start to edge back up? I don't necessarily worry about it too much in the sense we'll go to the daily so
Mm,
you guys can kind of see the history here. But this is the turn in the market that we started to see after it had clipped well above 61% on that spike. But the point being, to what I think you were hitting on, Versan, is there's a lot of opportunity here for
yes.
some of these risk assets like an XRP to really start to move. Obviously, with gold, I'm curious why the physical side? Because I hold digital gold, whether it's Tether or some Paxos gold. Why go the physical route?
Because it's real, it's something tangible, it's
Do you
something that
feel
can.
a digital gold could work?
No, of course. I think tokenization is all about taking real world assets and displaying that on a distributed ledger technology.
Yeah.
I do think XRP is the alternative to physical gold because it absorbs liquidity, it absorbs value. And
Yeah.
that's kind of how it reaches a higher valuation and functions as a digital store of value for central banks and financial institutions, even individuals itself. But the idea of going all digital just for the sake of argument
Yeah.
in the digital world, it's still something that I caution people.
Mhm.
I love the fact that I can sleep good at night knowing that I wake up in the morning and my gold is still here and my silver compared to my crypto being replaced or something along those
Yeah.
lines. It hasn't happened to me before because I have layers of security. However, I sleep good at night because I have my assets here, and that's important to me.
Yeah.
The importance of physical ownership is something that the next generation is starting to lose.
I think
They don't understand it as much as.
not yet, but I think there's a few that are starting to consider it, the physical side of things, whether it's silver, gold, and much of it has been brought into the forefront because of what's been happening to gold now over 4K, which seems to be the new floor of
Yes.
where gold is going. What are your thoughts about this whole business cycle refinance model that we're dealing with right now? The Fed, we know, is going to go into a QE model. this is going to create the flywheel effect again. So we're talking about refinancing, kind of a refinancing super cycle. Corporate debt is, I mean, the last time we saw these kinds of issuances was back in 2020. They have to roll that over. We're
Yeah.
at that point right now. So what does that mean in simple terms? I got to roll over all this debt. What is it going to do to the market? How's it going to affect crypto? How's it going to affect gold, silver, some of these other assets?
Yeah. So the way the debt-based system works is pretty much all debt most debt never gets repaid. It has to be refinanced, which basically means you kick it down the road, and essentially the government and nations, they have three options. If you can't pay the debt, well, first of all, you could default, which that's out of the question.
Yeah.
Very unlikely. The second option is pay the debt, which actually cannot be done because the financial system, first of all, would collapse because we need debt in the system to artificially inflate markets. So that can't be done. Even if they could do it, they wouldn't do it. But most importantly, they can't afford to pay the debt.
Yeah.
So the third option is to refinance it, roll it over, and basically kick the can down the road. So just for context, for people to understand how it's not the perfect example, but just to so people could understand how this would essentially work. But basically, imagine you have a loan from a bank and it's time to pay the loan off.
Yeah.
So instead, you can't afford it, you can't default on it. So what you do is you go to another bank and you borrow even more money just to refinance and kick the can down the road.
Usually at a higher rate.
Yeah, exactly. And that's why the government wants rates lower. It's not to help
Yes.
you to get a better mortgage. It's so that they could refinance their
Did you
debt.
see that launch 50-year mortgages the other day?
Yes.
Yeah, basically.
I mean, this just confirms that this is we live in such
It's
a
a
Ponzi.
scam.
It's a scam, right? And, real quick, I want to add some flavor to what my brother was saying is that stablecoins really change the dynamic entirely because they're going to be used to provide a new source of liquidity that will extend these cycles even further.
Yeah.
Basically, institutions can now manage systemic risk while broadening the dollar's hegemony status as well and market stability, but it's just disguised. So stablecoins are still not the solution.
Well, that's something that I think a lot of people don't realize. It's just shifting the fake money in as an asset in behind what really should be stable coins backed by gold and Bitcoin or gold and XRP or gold and other assets, which I don't think they're ever going to allow because the regulatory alignment, that's why the U.S. government is zoning in on the stablecoin market so much because they know this is the perfect out, for them, or at least partial out.
They're buying time.
I think, Paul, just to add to, just to finish what I was saying, the way the refinancing of the debt is going to push liquidity into the system, it's a simple concept that anybody can cement. Basically, the amount of debt in the system, in order to refinance it, it requires almost an equivalent ratio of liquidity in order to refinance the debt. Now, the bigger the debt is, the more debt that needs to be refinanced, the more stress it puts on the system, and therefore it requires even more liquidity. And eventually, every crisis that does come will just be a bigger crisis than the previous one.
Yeah.
And that's basically the situation we're in, and there's no way out of it. They're going to debase their liabilities, debase the debt by printing money, and keep the ball rolling for as long as they can until we get hyperinflation and civil unrest. And then by that time, the bazooka money will no longer work. But real quick, can I just add one more thing?
Yep.
On the stablecoin, for people to fundamentally understand what the stablecoin bill, the Genius Act, is really doing to the financial system, you have to understand the petrodollar, which took place in 1974. It was the deal between America and the Saudis, where we were born, actually. So they basically entered Saudi Arabia and they said, hey guys, you have a lot of good resources here, all this oil. It would really be ashamed if something bad happened here. So they put the Saudis in the corner in a position to use the US dollar for trade for oil. So, and what they do with 80% of that, they buy US debt.
Yep.
And this is the stablecoin bill is essentially,
Same
it's
thing.
the petrodollar 2.0,
Yeah.
just with a digital facelift. So now they have a permanent buyer for US debt, US treasuries, and therefore the system, they can keep kicking the can down the road artificially.
Well, and now they've got it in a position now, which I think is why you're seeing this administration so gung ho on crypto, which is a complete spin of where we were 24 months ago.
Yeah.
Is that they are understanding the exportability of the U.S. Treasury market now via the dollar, which is now going out to the broader markets via stablecoins, which of course plays into all of this.
Mm-hmm.
My question is this: Scott Bessent, pretty smart guy, I would say.
Bond salesman.
Best bond salesman. You know, I call him the digital asset salesman of the year.
You're right about that, Paul.
That was a good one. But you look at Bessent, you think about that. I mean, because I don't think Trump has a clue on where this is really going. He's just kind of following along his advisors the best he can. David Sachs, to a certain extent, I think he has more of a dog in the hunt for the AI side of things. If you look at Craft Ventures, and I won't go into a lot of that, but you guys go out and research David Sachs. He's got a lot of irons in the fire. Let's just say it that way. I won't say he's Nancy Pelosi 2.0, but he
For
could
crypto.
be of easily a Nancy Pelosi. He knows where all the bodies are. But you look at Scott Bessent and the potential here. Obviously, they're very upset with the Fed because they haven't accelerated the interest rate drops, which is it's putting a kink in their plan to get this refi going. What would Scott Bessent do you feel, that would make people believe that this is being partially addressed to where it looks like they've covered this up?
Yeah.
Some of the things he could do.
I think they're playing controlled opposition, to be honest. It's become very clear that this is what they do, really.
Yeah.
They play controlled opposition. They bounce back off each other to stir up arguments while nobody's focused on the ultimate goal.
Yeah.
They need to justify further liquidity injections to kind of cover up the data of the real economy and how things are actually falling apart. So I think this whole stimulus check thing now is another mechanism.
Yep.
It's another narrative too.
Yes, another narrative. That's right. It's a good way to put it. But ultimately, they're going to have to inject more liquidity. They're going to have to refinance things because if they don't, the whole thing starts falling like dominoes. Yes, stablecoins is one piece of it, but I think ultimately all this liquidity injections is certainly going to bring so much more opportunity into the crypto market and, of course, accelerate the digital grid.
How long do you think, guys, that we will be before the Fed finally succumbs to higher inflation? Because remember, he was already talking about he wasn't moving off 2%, and now he's at 3%. All of a sudden, within a year, the chair that we have today. So, do you think it's just a matter of time before they kind of normalize 4-5% inflation?
Yes, over time.
Destructive to the market.
It already is destructive. It's just, this is going to be realized by the majority of people eventually. And everybody, this kind of goes back to what we said earlier. Everybody is starting to realize that fiat currency is not what it used to be. It's not a store of value. So everybody's beginning.
No way. Yeah. I mean, this is a thing, it's obvious. I know you guys are in business to talk about this. The one thing that we're finding is this, and it's showing up in our channel numbers. More and more new viewers getting into understanding that assets are the only way out of this mess.
That's right.
And whether it's gold, silver, XRP, crypto, any kind of asset that can start to move, and even to a certain extent, some of the securities that are out there. But I think more and more people are waking up to this. My question, guys, is do you think it is too late for most of the American population? Because there is a big divide right now in did you guys see the numbers on people who owned assets and people who didn't?
Yes. Yeah, it's very, very scary, actually. Yeah.
So far away. I mean, it was a very small percentage.
Yeah, that ties us into asset inflation, because asset inflation isn't an accident. It's actually baked into the pie of how this debt-based system survives. The more
Yeah.
money they have to print to refinance things, the higher asset prices are going to go. And wages, when you compare that and factor in inflation to how much people are working harder and harder for less and less, the window of opportunity, the middle class is obviously being priced out of ownership in real time.
Yeah.
That's why you need to own the right assets, especially XRP and other things that can fight back against all of this,
Yeah.
because the window is closing indeed. So I think for majority of Americans, this is going to create a situation where I've always said this before. I'm not an optimist for the central bank digital currency UBI infrastructure. However, when you have a majority of the population that don't own assets, that don't have any savings, what are you going to do with all these people? You're going to
Yeah.
have to provide some alternative. And if it's going to be digital currency, you're going to have to give them some sort of UBI, universal basic income. So it sets the precedent for such a scenario to unfold.
It's very dystopian.
Very, of course it is,
Yeah.
yes. But if you even look at the broader Trump administration, and I'm not trying to get political here, but indeed they are trying to accelerate the digital grid.
Mhm.
Um, First day Trump was in office, he had Sam Altman there. He had
Yeah.
Larry Ellison from who worked on the Central Intelligence Agency's Oracle platform. I mean, all the pieces are in place, even Palantir.
Yeah.
So we see this economic hardship being inflicted on majority of people so they can be bridged into the digital economy.
Mhm.
And I
Yeah,
think it all
that's
ties
a
in
concern
together.
I have, is that we've already started to see this happen in the UK and
Yeah.
also in the EU to a certain extent. I don't know if you
Mhm.
guys have been watching the UK, but it's
Yeah.
absolutely shambles over there. And now, I don't know if I put out a tweet this morning. Ledger now was being blocked to be
Mm.
able from because of the UK. A lot of the regulatory scenarios that
Mhm.
played into this. Ledger, your own private wallet, was being blocked to where you could handle a secondary or the dual signature component. This is the kind of thing, and when that occurs on a self custody wallet, back to your point, Versan, is that physical assets are going to become a very interesting part of the economy
Hmm.
going forward, for sure.
Yeah. And that's why gold has broken away from the dollar.
Yeah.
I mean, that sets the stage.
Do you think we'll be in a position right now? Let's get into real estate because this is something that people kind of push back a little bit on me when I talk about this, and I've said it on the show out loud, and I've said, "Hey guys, real estate is the worst investment you can go into right now."
I
And the
agree.
only reason is you can't outpace the inflationary problem. And the problem is that you have all these leveraged loans against most of these real estate properties that don't allow real price scenarios to play out. So we're in an overpriced market. You'd end up basically be buying Bitcoin for like 200K if you bought a piece of real estate right now. It's well overpriced.
Mm.
So I'm like, go to the market that's going to give you some price appreciation, which is going to be either digital assets, gold, silver, any of those kind of things that can help you not into basically a money pit going forward. What are you guys' thoughts on how, especially with this issue? Because remember, this happened in 2019. We had a lot of loans that were reaching that refinance cliff, and the same thing's happening now in commercial real estate, which will move into residential real estate.
Hmm. Yes. I mean, I think all fiat currencies have become a victim of its own overuse. And when you start to look at assets that are denominated in dollars,
Yeah.
you have some issues there. I think when you connect all of the dots here from gold, silver, and metals and all kinds of other assets, even XRP, you start to see where all the money's going. And you're seeing a system that's gradually forming where basically real assets and digital rails are going to coexist and reinforce each other's existence.
Yeah.
So I think it's very important for everybody to really get a grip on this and understand the macro factors and implications, what this
Huge.
really means for you. So yes, real estate is extremely overvalued. We spoke with Gary Cardone once, or yes, Gary Cardone,
Mhm.
and off record he was mentioning how they were selling all their real estate
Interesting.
in Florida. So these guys have a lot of assets. They have lots of real estate. If you look at the Florida real estate market, it's not doing too well. It's just overpriced. And if everything is still in dollars with inflation, when you bake into the cake, you need to, I think, invest in assets that are going to fight back against a system that is currently stealing your purchasing power.
No doubt. And the Fed is right now really caught between fighting inflation. Obviously, we'll see that continue, and then preventing a liquidity crisis, which only resonates into some of the major markets, which real estate is one of them.
Absolutely.
Going forward.
Yeah.
So,
I mean, central banks are the only real players in this market today. I
yeah,
mean, without central banks at this current given time, I think
yeah,
the whole system would collapse. And that's why you see these rails being put into place. That's why you see some value in XRP on-demand liquidity and other sources of revenue, right? Where's liquidity going to come from?
yeah.
So there are a lot of questions and, moving
Think
pieces.
about this too. We are at that refi cliff right now. Okay.
Mhm.
End of Q4 trickles over. I think it's almost 30% of the commercial finance business is going to be hit immediately in January for a refi. They're going to be refinancing double or triple the previous rate that they were going. Because remember, we had 0 interest rates at one time,
Yeah.
not too long ago, guys. These guys will not survive at that. There's just no way. The price appreciation isn't there. The market pressure. Now you've got all these macro environments that are basically cratering the economy. There's no way that those kinds of assets survive, at least at scale. There will be a handful, sure. But do you think we're going to start to see some of these digital or some of these real estate investors actually pulling the plug
Yes.
and going the
Pivoting.
other way?
Yeah. Pivoting. I'll let my brother speak on this too,
Go
but
ahead.
central banks and I think very smart investors, they know what's coming. They're not reacting emotionally, including ourselves here.
Yep.
We're trying to rebalance our strategy. It's really that simple.
Yeah.
Central banks, big institutions, they're all buying gold more than any time in the history. Okay. And US treasuries are not doing so well. I don't care if you have stable coins, it's just buying time for the inevitable.
Right.
There's also a squeeze on silver. There's a squeeze on real assets. There's a reason for this. So I think it's just important, again, for everyone to get with the program and understand where this is really going. You need monetary asset hedges.
So, okay, let's go back to liquidity for a minute,
Mhm.
because this, of course, is going to be the lifeblood for this to actually sustain any time forward. The system needs more liquidity, not less, obviously. Liquidity is also one of the jet fuel components for risk assets.
Mhm.
We know that it's coming. It's just here. We're at that point. If you play into what XRP has done from the swell event, the amount of injection of capital, half a trillion dollars coming now in from the biggest banks in the world coming into Ripple.
It's
Plus, you
incredible.
look at just the element of what they have in terms of the financial stack now and what it looks like with G Treasury, Rail, obviously with Hidden Road. How does XRP win on this in terms of the other assets that are out there?
Like, you want me to go, Vendel? I'm happy
Yeah,
to.
I'll speak.
Okay, good.
Okay. So first of all, I think it's important to understand what Ripple is really doing here. This is the first thing. I think there's a very vague conception of what they're trying to achieve.
Yeah.
And I think there's some key concepts that need to be cemented here. So first of all, Ripple is thinking long term.
Mhm.
Okay. This is critical to understand. So essentially, there's a sequence of events that have to play out for XRP adoption to really take place at scale. So first, what they started doing is they built the infrastructure, the rails, the systems, the blockchain, the XRP ledger. And essentially, in order to move trillions in value across the globe, they need the infrastructure in place. So they built that. Secondly, and they've been working on it for over a decade.
Yeah.
Secondly, the second part of the sequence is building trust and embedding themselves within the financial system and within the foundation of the payment systems.
It's interesting you say that because that, to me, that was the biggest takeaway from Swell last week.
Oh,
Is they just pretty much put the gauntlet down. We're the most trusted company.
That's it. It's all about trust. And once this is the second, basically what I'm trying to say, that all large scale financial innovation throughout history follows a sequence of events before global adoption occurs. So they built the infrastructure. That's the first stage. The second stage is embedding themselves in the financial system, in the payment systems.
RippleNet.
RippleNet, yes, basically planting the seed and building the trust with the right financial institutions, the right banks. This is where the partnerships come in with the banks, the institutions, the payment firms. And the idea here is not to have these institutions immediately use XRP. The idea is to build trust and the relationship with the Ripple company, with the technology itself. That's the idea, building the bridge of trust. Okay.
Once they do that, ODL comes into play. You're
Yes.
talking
Yeah.
bridge currency pairs now at that, with
Yeah.
Well,
Well,
everything falls into place there.
but the third part of that is, as time goes on, all value virtually is going to be tokenized. And eventually, all value in the world, whether it's securities, commodities, real world assets, it doesn't matter. It's going to be tokenized. And eventually, as all the markets in the world start to move on chain, there will only be a handful of blockchains that actually have the reliability, the trust, the scalability, and the liquidity to process trillions and all that value at scale efficiently and effectively. So by default, all the money in the world will only have a few options at the end of the
I
day.
hear that a lot.
Yeah. So it's a sequence of events that need to play out, and it's a long-term intentional strategy that they have.
And you think about it, while the Fed is injecting liquidity, whether it's repos, parallel system, is now in the process of being built. And guess what? It doesn't need overnight lending.
There you go. Yeah. I mean, what they're doing is essentially buying time until all this infrastructure is in place so they can go ahead and migrate. And that's where it becomes increasingly clear, to my brother's point, that Ripple has positioned itself and cornered the entire traditional financial system. And it's also cornered the emerging digital economy. I mean, think about it.
Do you think this is why some of these chains are so upset at Ripple right now?
Yes, and it's been like that for a very long time. But the good news is that they have the full regulatory alignment along with the new frameworks that are being built. This is slowly becoming a public trend. They've been leaving breadcrumbs for more than a decade now. I think a lot of us have seen that. Ripple is not really just a bridge for value transfer anymore. It's gradually becoming a central solution for banks worldwide, central banks and financial institutions. And now they're even moving towards obtaining a full banking license. So this fundamentally changes the dynamics of the entire conversation. And it goes back to the foundation here, is that the infrastructure is being laid to rewire the rails of a global financial system.
And
So
eventually,
you
all
can
of it is
also,
going to go on chain.
yeah, and you can confirm to a degree, I think this will be revealed in due time, that XRP is indeed on its way to becoming a global reserve asset for a new kind of system. Because think about it, the other side to this is to understand how XRP actually evolves into a global reserve asset. There are a few pillars that must align. Number one, sovereign adoption. Check. We got that. Regulatory clarity. Check. We got that.
Done.
Now the Clarity Act, we're waiting on that. So we can check that eventually. And then, of course, the final piece to this puzzle is the institutional recognition, which ultimately will come from probably the IMF. We will see.
Well, think about this too, guys, though. If you think about liquidity crunch in TradFi, which is now underway, and the opportunity for crypto rails is real. If you think about banks that won't lend to each other, instead you got a blockchain really doesn't really care about counterparty risk. So that's the ultimate. So settlement would essentially happen instantly. No repo market would be needed. I mean, these are the kind of that is a reset of the system in itself, which is going all on chain at that point. If something like that were to occur, And it could happen in a very short period of time. Granted, it'll be like very slowly and then all at once. What do you
Mhm.
think happens to XRP?
Oh, this is the fun part, actually. This is where you start to look at the mathematics behind it.
Yeah.
When you start to look at its intrinsic design and how does it actually achieve a very high price. And this is where you do have to focus on the design instead of the speculation and the noise around it, really. It has the power to be divisible. So each XRP can be divisible into 1,000,000 units. That's a
Yep.
big game changer right there. You have the liquidity efficiency and high value utility. That's kind of the things we've been talking about for a long time. You focus on global liquidity, and that's where demand and supply come in. And then, of course, fractionalization for institutional settlements. Like the higher the price of XRP is, the more efficient it is. So you do need a higher price. I have a video coming on this tomorrow. It's going to be very exciting where I actually break down with AI the mathematics behind it.
Oh, I
And I
like
give
it.
people visualizations showing like more XRP tokens, right? You're spending more money. You're not saving money. But with the higher XRP price, you're actually saving institutions money. So it also confirms, because of this divisibility and fractionalization, that XRP, no matter what price it is, it could be used for institutional settlements and microtransactions as well.
Yeah.
So it's just very interesting to see
I
how.
I want to end with, what to watch, because there's a lot, like we talked about, there's a lot of things happening all at once. And if you think about this thesis playing out, which I think you guys do as well, what would be some of the categorical confirmations? If you think about the Fed's reverse,
Mhm.
repo facility, that's going to be one. How much cash is parked there? We've already seen these numbers revealed over the last couple of weeks,
Uh,
getting these ridiculous spikings. So if
mm,
you look at that, and then you also consider maybe the corporate refinance announcements, and if we get any defaults, that'll be another factor. What about you guys?
okay, so I will tell you the most critical warning signals to watch that has historically flashed only 3 times in the last century before we entered a severe market crash and
Yeah.
recession. Okay, so what I'm paying attention to, what we are watching, is the 10-year versus the 2-year
Hmm.
yield. Okay, zooming in closer in on that is the 10-year minus the 3-month yield. In addition to that, the third indicator we're watching is high yield credit spreads. Now, what's interesting here is everybody starts screaming, oh, the yield curve is inverting, and they think that's a recession indicator. Okay, it's not. The last final warning before all hell breaks loose is when the inversion of the yield curve reinverts and steepens upward.
Yeah.
Now, that's only happened 3 times. We had it happen in 1929, right during the
Black
great
Monday.
financial the market crash. It happened in 2007, a few months before the great financial crisis,
Yeah.
and it happened in 2000, right before the 2001
Uh-huh.
dot-com bubble and recession.
Yeah.
Now, guess what? Today, we watch these on a daily basis. The yield curve inverted around 2022,
Mm.
and it came up slowly, and right now it's remaining in a range. It's flat. But as soon as that starts spiking and steepening upwards, it's game over.
Yeah.
All the markets are going to take a hit, and the real economy is going to reflect in the financial markets until the Fed has to intervene and inject artificial liquidity to save the
So
day. Yeah.
okay, so with that being the scenario that plays out here, Vandal, is what would be the safe zone? If you're looking at literally the entire market could take. Remember, a lot of risk assets, digital gold, what we're seeing with Bitcoin, ETH, all that, those things didn't really exist in 2008, the last time that we really saw this, and definitely not in 2000.
Yeah.
So what survives?
Hmm. I mean,
Well, this is when tactical portfolio allocation comes in very handy, because I think for any investor that's positioning from 1 to 2 or 3 years, the first critical question they have to ask themselves, based on their positioning, is, should I be more aggressive or should I be more defensive? So given where we are in the market, the macro environment, the circumstances, one has to question, should they be more aggressive or defensive? Because if you're more aggressive in a market that requires you to be defensive, you're going to get chewed up.
Yeah, you're going to get.
And if you're more defensive in a market that is risk on and extremely aggressive, then you're going to leave a lot of money on the table.
Yeah.
So people have to get clear with what their short-term goal is between a 1 to 3 year.
Yeah, and I think the window is narrowing now.
It is narrowing.
Absolutely.
Yeah, we're actually at the end stages of this cycle. We're at the end stages of this liquidity cycle and the end stages of this crypto cycle. So we're not at the peak yet, but we're getting closer to the end. And we're seeing all the signals flashing, the dynamics in the crypto market, the market behavior, the huge liquidity liquidations, like the recent $20 billion liquidation, the flush outs. These are events we've seen throughout every cycle before the next parabolic phase occurred. But of course, once prices start getting pushed up to irrational levels from renewed optimism, human emotions taking place, such as hope, greed, that's when these prices get pushed to irrational levels, and eventually that leverage will have to leave the system, and we will have a crash, So we're currently at the end stages of the cycle, but we're not at the peak. So what I'm saying is we still have asymmetric upside, and Bitcoin, historically, every time it has closed a weekly candle below the 50-week simple moving average and the exponential moving average, that has marked the top and end of the cycle. Just yesterday, the 50-week moving average actually closed above. And then you see the markets riding up now. So we already knew this a day in advance before the market started going up. We saw it in the Bitcoin chart. So essentially all the signals are telling us we still have asymmetric upside, but we're getting closer to the end stages of the cycle. So right now it's very critical to really start thinking about how you're going to protect your wealth and your investments. Because this is not the beginning. The low of the cycle was in 2022. Okay? And currently, we are in a 43-year secular bull market since 1982. Okay? So something will have to give at some point. And we're at the 18-year phase of the real estate cycle. All these events are converging at the same time. And it's crazy because a lot of people say, oh, just buy the best quality assets that have good fundamentals and you'll be good. But let me tell you something. In the 1960s, all financial advisors and funds were telling their clients, hey, just buy the Nifty 50, which were the best companies at the time, the best performers. Well, from the 1970s, 1973 to 1974, the best companies actually crashed more than 50%. Okay. And it took approximately 8 to 9 years by 1981 to 1982 for the market to recover to the point where it was before the crash. So the point I'm making here is that it's not always about what you buy, but when you buy is just as important. And that's why it's very critical for people to understand that just buying something that's good, fundamentally speaking, isn't good enough in today's regime, because the markets are primarily driven by liquidity and not the real economy. So we're going to constantly go through these boom and busts. And I do think timing plays a critical role today more than ever.
Yeah. I mean, that's a good point. Can I also add something to what he said? This is something I've noticed a lot of technical traders really don't understand, is that the crashes and corrections you see, they don't just start because assets are too expensive. It's very important, but they actually start to come down because the collateral behind them is collapsing. And when collateral values fall, you have margin calls. That's where you see forced liquidations like we recently saw, and fire sales that cascade, and it drains liquidity even faster, accelerating the downturn that he's talking about. And again, this comes back to the beginning of this discussion. We are at the end of the greatest monetary experiment in monetary history. And I would say also that this is a slow, controlled demolition of confidence in fiat, and of course, the evolution of the debt-based financial system and the rise of an entirely new monetary infrastructure being assembled. It's all tied in together. So what I'm encouraging my listeners to do and our investors is have a multi-tiered strategy. So outside the system, you need to have some physical gold, physical silver. That's really where you're going to protect yourself. You need to get your cash outside of the banking system. You need to build long-term wealth growth preservation investments like XRP and other assets that will absorb liquidity. So yeah, it's just a lot of moving pieces again, but Mendel made some very good points there. I think you're silent.
Yeah, and I think the upside to this, guys, is that when you look at what we're dealing with right now, timing back to what you mentioned, Versan and Vandel, is I think this all comes down to when we see this upside, whether it is the next 3 months, 6 months, whatever that might look like. This is something that you cannot fall a trap into the trap of crypto, and that is getting that euphoria and thinking that this is just the beginning.
It's happened many times. We've seen it many times.
You're right, Paul.
So you guys know what to do. Hit like and subscribe. Make sure and hit Black Swan's Capital. I will make sure and put their YouTube channel up right here so you guys can go out and visit and subscribe to Versan and Vandel. And guys, it's always fun chatting with you. We always get in deep on these conversations, but they're well worth it. But thanks for coming in today.
I love it.
It was a real pleasure.
Paul.
Thank you so much, Paul.
Good seeing you, buddy.
You guys know what to do. Maybe you could do one more thing, and that is, of course, spread the news. Let other people out there that have not invested in assets yet, let them in on the secret. Help somebody else out. So thanks again for coming in on the XRP pod. We'll catch you later. Take care.
Take care.